So I'm delighted and very honored to introduce Darrell Duffie. What stands out about Darrell, and is maybe a little frustrating to the rest of us, is that he does everything so well. In fact, he never says anything stupid or silly or wrong, and leaves a remarkably thin trail of funny stories. So he is the most completely unroastable person in this room, and therefore I won't try. Now, if you're under 45, you met Darrell in your graduate studies. He's the guy who wrote the book. Now, you may have had an occasional unkind thought about Darrell, facing a problem set at about 2 in the morning, but at least you knew where to look for the answer. And of course, that book stood on a set of classic papers which developed the mathematical foundations of financial economics. Now, people who write papers like Competitive Equilibria in General Choice Spaces are supposed to spend the rest of their lives in an ivory tower spinning out beautiful theories. Not Darrell. Darrell went on to develop the modern toolkit of term structure and credit modeling, with co-authors and especially with Ken Singleton. And to me, this work stands out for its immense practicality. These are the models we use. Theorists are also supposed to be very abstract, but Darrell has always thought carefully about the mechanics of markets. I'm a big fan, for example, of his work on short sales and over-the-counter markets with Nikolai Galiano and Lasse Peterson. This work showed us how searching for a counterparty can affect asset values and in a way that explains important puzzles. Darrell wrote a paper on special repo rates, emphasizing collateral problems, in 1996. Long before the rest of us had even heard of such things, or at least me. Well, now we have. In financial crisis discussions, it's always Darrell who pipes up with, no, guys, that's not how the CDS market actually works. If you want to understand what the fail in Too Big to Fail really means, you absolutely must read his Failure Mechanics of Dealer Banks. But Darrell, high priests of mathematical finance are not supposed to also be the one guy in the room who also understands the institutions. Darrell hasn't given up on deep theory, and I don't mean to imply that, of course. His recent work on percolation, at least as I understand it, addresses the big unsolved problem in finance, how trading works to bring information into the market. Theorists are supposed to be inscrutable. Well, Darrell is probably the clearest presenter in this room, as something you will soon see. I heard one good story, and I didn't verify it because it can't be improved by the facts. A judge was apparently getting fed up with the experts arguing with each other in a complex securities litigation case. He told both sides, "Stop, go get Darrell Duffie to explain this to me. I don't care what you have to pay him." He was a wise man. Theorists are supposed to be unapproachable. Darrell is famous as a teacher and as a mentor. His students wrote lots of nice things for him while nominating him for a Stanford Award. And the best, I think, is this. Darrell makes you feel important. He respects your ideas and wants to help you develop important questions. The job of AFA president is an academic honor, but it's also an important administrative position. Darrell turns out to be great at this too. He's always there answering an email in about 5 seconds flat with exactly the right thing to do. His efforts have left important legacies for our association, and when you elected him, you chose wisely. Well, you might console yourself. Someone so accomplished as that, he must be a geek who just sits in his office all day and let himself go. Nope, not again. If we were to take a break and run, or let's take a little bike ride, a little tour de hotel around, it's an easy bet that Darrell would be the first one back. Well, so much for the theory of comparative advantage. Darrell does it all with style, grace, and wit. In the preface to his textbook, Darrell wrote, humbly, but I think a little depressingly, that theoretical developments since 1979 have been a mopping up operation. But he hedged his bets. He also wrote, it's difficult to predict what the future will bring. And now we've seen a little bit of that future. Far from mopping up, I think we're in a second golden age of financial theory, looking at Darrell's work and that of a lot of people in this room. And I can't think of a better person than Darrell Duffie to tell us about it.
John, I thought you were going to try to knock me off my my rhythm here with the hard time that I gave Jeremy last year. Instead, you've set me up for disappointing the audience. I'll try to be clear. I want to talk about something that I've been obsessing about for about 10 years, which is why asset prices react so slowly to supply shocks. I'll just give you a quick schematic and then introduce the subject. We've all worked on theories that explain expected rates of return. Many of those theories are based on the idea that all investors are present in the market at all times, ready to trade. I'm guilty myself. Continuous time modeling, it's based heavily on the idea that everyone is adjusting their positions instantaneously with information, and in particular, my subject today with supply shocks. Now, once you introduce illiquidities in markets, in order to capture the idea that people are not instantaneously present and adjusting their positions all the time, you really, I would say, can't capture it well unless you include the supply shocks that shock you out of a stationary state. So rather than looking today at a stationary illiquid market price, which given the state of the art is sometimes difficult to distinguish from an efficient market price, they're both flat, I'm going to focus today on situations in which there's a significant change in the supply or the demand for the asset at a point in time, and look at the price reaction and recovery. Now, everyone, I think, in the room has the intuition for this pretty clearly already. We've all heard about price impact. We all know that once a large block of shares, for example, arrives in a market, the price tends to drop quickly. And as many of us know, it doesn't necessarily sit at the new price forever. It tends to recover depending on how large the supply was, and my focus today, depending on how long it takes for those that were there when the block of shares arrived to distribute it to other investors over time. So this, I think this concept is relatively intuitive. What I'm going to do this evening in the next few minutes of modeling approaches and empirical evidence and try to convince you that this is a worthy subject for more research, assuming that the laptop cooperates. Well, let's advance with this one. There we go, just slow. Okay, so my first example, which was prepared with the help of Jeremy Graveline, who may be here tonight, is what happens when one of the roughly 500 stocks in the S&P 500 is no longer in the S&P 500. It gets kicked out. Now, there's some informational aspects to this sometimes. Usually it's just that it's a relatively small stock among those 500 large stocks. What you're looking at on this plot is the cumulative return on that, or on average across 60-some deletions from the S&P 500 over the subsequent days. So if you can see the plot, on the day after the deletion, on average over 60-some deletions, the stock drops 14%. That's not basis points, that's not annualized. The price goes from, say, 100 to 86. And it doesn't sit there. This isn't just an informational effect leaving the S&P 500. It recovers to some large extent over time. And there are various papers that have both described this effect and tried to explain it. Going back to Schleifer and Vishny, a more recent paper that lays out the evidence quite clearly and describes various alternative hypotheses is by Chen, Noronha, and Singhal a few years ago. As I said, I've been obsessing about this for some time, trying to capture this effect in a model, and using a model then try to go backwards and figure out from the behavior of prices, what is it about investor behavior that is consistent with that and would help us understand how markets work. Now, tonight I'm going to apply Occam's razor, which is simply that investors are slow getting there. not necessarily irrationally slow. It's just that we don't all hang out watching for these things at every moment in time. Some people do. They get a bargain if they happen to be there when the stock is dumped into the market. Remember, the S&P 500 stocks are held by index funds in very, very large quantities, on the order of several $100 billion. If one of these stocks comes out of the index on a given day, then several $1 billion worth of stocks that must have been held in the index funds the day before now must not be held in the index fund. Somebody else must step in and buy them. And if not everybody is there at the same time bidding for the opportunity to buy them, then those few that are there need to be compensated for holding all of those billions of dollars of shares by being given those shares at a low price and a high expected return. Now, over time, of course, they're not interested in holding a large block. They want to pass it on to buy and hold investors or to other investors that come along. And the price will recover to a large extent, not necessarily entirely. Later on, I'll give you a model which is the simplest possible model that I can imagine, a neoclassical model with one adjustment, which is simply that some traders are slower than others. Slower not in the sense that they're less intelligent, simply that they may have a higher value of their leisure time, or they may not necessarily want to be monitoring their positions at every moment in time. We have a very sophisticated audience here. Let me just ask for hands. How many have actually adjusted their position in the market, some securities market, in the last week? Okay, so aside from those that might be too shy to say so, I'd say that that's less than a few percent of the audience. Maybe if someone collects the data tonight, we'll get one more sample point. So we're not there all the time monitoring our positions. We adjust our positions when we get around to it. Sometimes it's not just a question of transactions costs. In fact, I'm focusing tonight on a situation in which we are very busy. We have a time horizon at which we think it's time to go back and monitor our portfolio and come back and then adjust our position. That little bump in this plot of the price reaction I'll get to later. There's different ways to get at these price reactions. The last plot that I made is not based on an over-the-counter market, but there has been some progress in analyzing these price impulse and slow reactions in over-the-counter markets, and there the natural friction is simply the fact that in an over-the-counter market where there's no central marketplace, it takes some time to find a counterparty. John Cochran mentioned the securities lending market as a good example. Corporate bond markets, in fact, almost any bond market is an over-the-counter market. There is no central exchange where there's liquidity. You simply shop around, and it takes time. It takes sometimes longer than you might think. Here's a theoretical example from a paper that I did with Nicolai Gerliano and Lasse Pedersen of an over-the-counter market in which, at a particular point in time, the asset suffers a supply shock. For example, many investors find that it's no longer an attractive asset. Perhaps it's an institutional reason, like a tax or a regulatory change. Those investors now will go out and look for someone to buy that asset, and it may take them some time to find a suitable counterparty. When they do, the price that they negotiate will reflect their bargaining disadvantage, being looking for a counterparty and having an outside option, which means they have to look again for another one if they can't conduct a trade. And the price also reflects their counterparty's position, which will be roughly the same once the counterparty buys the asset. The price reaction, the degree of the price drop and the speed of the price reaction both reflect a parameter in this model which is called lambda, which is the intensity, that is the mean arrival rate of contacts with other agents in the market. Now, depending on the market, the time scale on the horizontal axis could be months, weeks, days, hours, minutes, or seconds. And some markets, for example, the federal funds market, on which I've analyzed some data with this perspective, the half-life of this price recovery is on the order of a few minutes. As opposed to a centralized market in which anyone can trade at any time simply by, for example, getting onto an E-Trade screen and entering a limit order or a market order to buy or to sell. In this situation, it's not a search friction necessarily that's causing these supply shocks to have such a big reaction. The real world is probably something more like what's illustrated in this picture, which shows that there is a central market. It may have a limit order book in the middle of it, but many investors are not directly trading on that limit order book. They have their assets managed by asset managers, which may include hedge funds, mutual funds, private equity. It may include asset managers at investment banks, brokers, dealers, and so on. Now, in a moment, I'm going to give you an example of a intermediated market, as illustrated here conceptually, that was severely broken during the financial crisis. The red dots representing the hub dealers in that market lost their ability to provide intermediation to the blue dots on the periphery of the market. That will provide some really dramatic supply shocks. As for theory, I'm not going to explain some recent work that I did with Bruno Strlovich, but let me simply motivate it very briefly. At any given point in time, different markets which may have the same type of risk may reflect different risk premia. This is a kind of completely contradictory to lesson 1 in our PhD doctoral asset pricing classes, in which we teach that every asset that has the same kind of risk bears the same kind of risk premium. But if you get two markets, one of which has an excessive amount of capital and another of which has an insufficient amount of capital, then the risk premium, of course, will be based on supply and demand locally. It's not that markets are completely inefficient. The capital will move from the market which has too much capital to the market that has too little capital, but no one in reality would believe that that process takes place instantaneously. It may take, as I said, seconds, minutes, hours, days, weeks, or months. In the insurance market, it takes years. This is the catastrophe risk market. I was triggered, my interest in this market was triggered by Ken Fruit and Paul O'Connell a number of years ago. They wrote a 1998 paper that intrigued me because in this market, when a hurricane or a natural disaster occurs and wipes out the capital of large catastrophe risk insurers and reinsurers, in this diagram, the big blue bars represent the claims against insurance firms from catastrophe losses. The red line, which represents the risk premium, that is the price for insurance in this market, will adjust, but only over years, to the loss of capital in that sector. So, for example, if Swiss Re loses a large fraction of its capital due to Hurricane Andrews, which is exactly what happened, then the price of hurricane insurance goes up to reflect that lower capital, but it takes a year or two before those insurance firms are recapitalized. Now, you might say that's completely contrary to incentives and what we know about smart investors, but this is a particularly difficult market into which to move capital into. You have to, first of all, find a very special kind of investor. You have to establish a new hedge fund, a new insurance company, or negotiate a stock purchase by, that is a stock issuance by one of these companies. You might say, well, why don't the insurance companies immediately raise new capital? Well, we're going to talk about that when we get to the financial crisis. There are many cases in which corporations that provide risk-bearing decide not to raise capital instantly when they lose capital because of a problem that Stu Myers identified, which is called debt overhang. If they were to raise capital instantly in response to a loss in capital, then they would essentially be donating money to their creditors. The first dollars of capital raised would go to making the creditors safer. And in some situations, debt overhang is severe enough to hamper the migration of capital into an industry such as insurance. There may also be adverse selection problems identified, for example, by George Akerlof's theory of lemons. If I approach someone and ask for capital, then the price at which an investor pays for that capital will probably not be the same price at which I'm willing to raise capital because of adverse selection. Lest you think that this is something about hurricanes, no, it's really about the capital levels of the insurance companies. This is the, sorry, the clarity of the plot, but this is the pricing of insurance in different lines of insurance handled by these insurance companies. So aviation, marine, catastrophe risk, non-marine, motor, these are all moving in tandem, not with our capital asset pricing model based theory about how these risks are correlated with consumption, sorry Doug, but in this particular instance, this market is so illiquid that these risk premia are adjusting mostly with the amount of capital that's in the insurance companies. Now to the financial crisis, this chart is from Mitchell and Polvino showing what's called the CDS basis, which is essentially the difference between the yield spread of a corporate bond and the yield spread for the same corporate bond that's presented by the credit default swap market. In other words, if you have a corporate bond whose yield spread is 6%, this chart indicates that if it's an investment grade bond, there are times during the financial crisis when the same effective credit spread in the credit default swap market was 400 basis points, 200 basis points less. Another way of looking at this is you could buy the bond and insure it with a credit default swap, turn it into a risk-free bond, and profit by, for the investment grades, 200 basis points above and beyond the profit associated with a treasury. Now, it's not quite as simple as that, as motivated by work by Marcus Brunemeyer and Lasse Pedersen in their important paper, Market Liquidity and Funding Liquidity. The markets that we're describing, the markets for corporate bonds and credit default swaps, are intermediated by dealer firms. And if those dealer firms are hampered in their intermediation by a lack of capital, then these two markets, the ones reflecting corporate bonds directly and those reflecting credit default swaps, can be way out of whack. In this particular case, the issue is that it takes more capital to buy a corporate bond than it does to enter into a credit default swap. In addition to this work on the CDS basis, there's work by Pierre-Colin Dufresne, by Lasse again, and Nicolai Garliano, and by others that uses this as an illustration of an extremely broken market. In this case, you should not think about the slow-moving capital as capital moving from the corporate bond market into the CDS market. Yes, there's a barrier of movement of risk capital from one market to the other, but the real barrier, the real slow-moving capital, is into the financial intermediation business, into the dealer banks like Morgan Stanley, JP Morgan, Citibank, and so on. The banks that make these markets lost a lot of capital during the financial crisis. Their capital was scarce, and as explained in the paper by Marcus and Lasse, that can dramatically affect the prices for financial assets and can introduce these kinds of broken trades. Here's another one, which is called covered interest parity. This is the difference effectively between the price for buying forward in the derivatives market of foreign currency and the price for buying the same currency indirectly by borrowing in that currency and funding the cost in your home currency. These violations of covered interest parity are going to make all of our lives difficult now from when we're teaching MBA finance, because I don't know about you, but it's one of the first arbitrages that I teach. Those of you think that this and the other example are really simply evidence of counterparty risk in the derivatives market, no, you can check the numbers. It's not even close. It has to be explained by slow movement of capital into the dealer markets, and I think in this case again, the debt overhang problem is really the friction that we're talking about. Mike Jensen's agency cost, in this case, the agency cost is the fact that equity owners would rather not harm the value of their shares by raising capital. In this case, we had a reboot thanks to Ben Bernanke and the Federal Reserve System, as well as the TARP. This particular reversion to normal pricing that we're now seeing is not of the sort that I'm going to be interested in for the remaining few minutes. This is really a one-off, hopefully one-off for a long time, broken plumbing system. That is, the financial system was basically broken. This is not due to trader delays. Okay, so let me just give you a quick wrap-up of some of the empirical evidence, some of which I've mentioned, of these extreme supply shocks and slow recoveries that are difficult to explain with standard theory. I mentioned the catastrophe risk insurance claims and Fruit and O'Connell. I'm going to mention in a minute some work by Koval and Stafford on fire sales for mutual fund redemptions. Peter Feldhuchter's on the job market this year. He's looked at an over-the-counter market model of price reactions caused by the Ford GM downgrade in 2005, which took Ford, or threatened to take Ford and GM out of the Lehman index of investment-grade debt. I forgot to mention when I prepared this slide that there's a new paper by Chen, Luckman, Scherhoff, and Seppi that addresses the same problem. Equity market order imbalances, as suggested in the theory by Grossman and Miller, and in evidence in many papers, but I'm just mentioning Andrade, Chung, and Seasholes, as well as Hendershot and Seasholes. When we get supply shocks in the equities markets, the recovery time is sometimes on the order of a week, despite a relatively liquid market. Index recompositions, I mentioned the work of Chen, Noronha, and Singhal. Greenwood, Mitchell, Pulvino, and Stafford, which I'll mention in a minute. Stock and bond issuances. This is when a large supply of stock and bond arrives in the market because of the issuer, either in a primary or secondary offering. I'll talk about that. And I've already mentioned some various broken arbitrages from the financial crisis. There are several others. Okay, and as far as related theory, well, as Mike said again, we're all, and Doug as well, we're all building on the work of others. Foundational theories by Grossman and Miller. I already mentioned Marcus Brunnermeyer and Lasse Peterson's paper. These papers deal with a market in which when outside orders are not arriving at the same time, then the inside market, as I mentioned earlier, has to intermediate that trade on its own capital. So these intermediaries can be thought of as the investors that are there all of the time and have to catch these supply shocks in their arms, and sometimes they're only willing to catch them at a relatively low price. By the way, everything is symmetric. If it's a demand shock, then the price will jump up and then go down over time. I already mentioned some work related to search delays. There's a paper related to the effect of delayed trade by Nicolai Gerlianu in a stationary setting, and there's another paper by Ionid Rossu, which I think is one of the most impressive and least recognized important contributions to our understanding of limit order book markets, just published this year, that help us understand the impact of delayed trade on the behavior of prices. And then there's been some work over the years on why this is not a behavioral, that is slow to trade investors are not necessarily behaviorally impaired. In fact, you might say just the opposite. Anyone who's so obsessive that they're watching the screen and reading financial fundamentals on every asset at all times clearly has a behavioral problem. Okay, now let me give one or two more examples and then a modeling detour. So here's an impressive example, a little bit of detective work here by Mitchell, Pulvino, and Stafford, some names that show up a lot in the empirical literature. Imagine what happens when there's a merger and the acquiring firm is in the S&P 500, but the target firm is not in the S&P 500. What that means is that on the date that the merger is effective, the acquiring firm is now a much larger part of the S&P 500 than it was the day before. That means that every S&P 500 investor needs to buy more of that stock, effectively. It's a larger part of the index. There's a big increase in the demand for those shares. If the acquiring firm is and the target firm are both in the index or both are out, you don't get this index rebalancing effect, a supply shock and a recovery. Another intriguing design, one of my favorite papers in the literature, Koval and Stafford. In this case, the supply shocks are not directly observable. what they are the effects of redemptions of mutual funds. So imagine everyone in the room holds various mutual funds. At various points in time, you need to raise cash. Your daughter's getting married, you need to pay a tuition bill, or you want to cash out of the equity market more generally. Some of your motives may be fundamental, but there will be some equities that are caught up in these liquidations that happen to be victims of mere liquidity shocks that are common across many different mutual funds on a given day. Now, we don't know necessarily contemporaneously which of those equities are being subjected to these liquidations, but Coble and Stafford were able to go back and detect the amounts or estimate the amounts of these shares represented in the red bars that were sold, and then were able to trace the cumulative absolute return on those shares over time. Now, I want you to pay special attention to the horizontal axis. The scale is in months. Because these supply shocks are not directly observable, the impulse response, that is the price reaction to the sales and the recovery, is occurring over a very long time scale. Okay, here comes a bit of a model that I developed in order to make this presentation, to make it as clear and as simple as possible how simply delayed or inattentive investors, inattentive not necessarily in an irrational sense, but you could view it in those terms. It could be that people have value for their time. We're going to assume, we're going to take a model which is about the most neoclassical model used in finance, with one change. We're going to take some of the traders and assume that they're not at the market at every moment in time. So some fraction Q of the investors are going to be inattentive for K periods of time after each trade. Now, a period of time, again, could be in seconds. If it's a limit order book market, it might be in months if it's a less frequently traded asset. Each one of those investors waits K periods after each trade. At any particular period, 1/k, that is 1 over K fraction of those slower investors are present in the market. The remaining fast investors are there all the time. It could be that they're sophisticated. It could be that they have low costs for their time in trading. It could be that it's their professional, it's their job to provide market making services. It could be a hedge fund. It could be a stat arb fund. The asset supply and the dividend process for the asset in question for modeling reasons are taken to be jointly Gaussian and autoregressive. And all investors have additive exponential utility, and for tonight I'll assume that they all have the same risk aversion. I'm not going to pay attention to the riskless asset because, as most of you know, in this sort of a model, the risk-free rate does not play a direct role. In fact, it's not determined when you're talking about the pricing of this particular asset. So again, a very neoclassical model with one change. The change is illustrated in this picture. Imagine you are in the market at period T. The blue bars represent the demand of slow investors at lag periods. So arriving in the market today is are the investors that invested K periods ago, and they're bringing with them the shares that they purchased or sold at that time. Whatever their position was, they're coming back into the market. The investors that arrived one period later, that is at time T minus K plus 1, their shares are still held off the market. They won't be back until the next period, and so on. Now, that means that one of the contributions to the pricing of assets in this market is the list of the demands of all of these slow investors over the past K minus 1 periods. And when I first looked at this model, thought about, should I really try? I was discouraged by the idea that this was going to be a nuisance to deal with. And then, once I warmed up to the idea, I realized it's actually a good feature of the model to incorporate. The transition of this holdback vector of shares from slower investors is relatively easy to model. Everybody just shifts over 1 when you go ahead 1 period, and you insert the red letter DT, the new demand from last period of the new slow investors that are going to be held over for another k periods. So the dynamics for this vector are relatively simple once we understand the demand of the slow investors. The rest of the model I can explain on one page. So here it comes. I'm going to go slowly on this slide, and then the rest of the talk will finish, and we'll be well in time for the reception. So just hang in there. Whenever you see a lot of algebra or symbols, I know there's a tendency to zone out. If you can hang on for one slide, I think you'll get the idea of the model, and I promise no more notation. John yesterday accused me of having a lot of complicated equations, so I was a little bit sensitive. Okay, so we're going to go down this page bullet point by bullet point. First, just a reminder, you've got to keep track of the holdover vector, that is the history of demands of slow investors from previous periods. They're vintaged. Once you do that, the entire state vector consists of three elements: the supply, zt, the dividend, xt, and this vector ht, which is endogenous to the model because it's based on demand. Now remember, zt and ht are by assumption an autoregressive Gaussian process. And just to take you back one slide, the transition from ht to ht plus 1 is very simple. In fact, it's linear on all those blue arrows. Shifting over by 1 is a linear operation. Only thing we have to worry about is whether the red d is in fact also linear in the state vector. But you know that I wouldn't have gotten this far if I hadn't arranged for that. Because this is a Gaussian autoregressive setup, and I have exponential investors, we anticipate that if the prices are linear in the state vector, represented by the next bullet point, st is a linear combination of all of the elements of the state vector, we can anticipate that the demands will also be linear in the state vector. And that, I think probably 95% of the people in the room have actually proven that for themselves, possibly with a different state vector. That is, for the one period agents, the ones that are there all the time, their demands will be linear in the state vector because the mean returns on the assets are linear in the state vector, and the variances of this particular asset, because it's a Gaussian model, the variances are deterministic. Now, the means and the variances do depend on whether you're investing for one period or for k periods, but humor me, let's suppose that they're linear and we'll be able to confirm that. The dynamics. Well, we've already assumed that the supply and the dividend process are linear autoregressive. If the demand by the new slow investors is linear with respect to the state vector, then it's automatic that the entire state vector is a linear autoregressive process. It does happen that the matrix A by which you multiply the state vector depends on an endogenous set of coefficients, those that determine the price. But nevertheless, we have a linear autoregressive system. I'm looking at the stationary case in case you haven't figured that out. It's also the case that the expected price in k periods will depend on the expected state vector in k periods. And this is just compounding. If y at t plus 1 is ay at t plus b times some noise, then the expectation at y at t plus k is just the matrix A raised to the kth power times the state vector. Okay, so we now know how to, given the coefficient c, we now know how to calculate the demands of all of the investors. Demand for the long-term the slow investors, the fast investors, has to add up to the total supply, not the total supply z, but the supply that's available on the market. What's available on the market is the total supply z less all of the shares that are held off the market by slow investors. And that's the key to the model, the fact that the supply depends on how many shares are held off the market by slow investors. All of those are linear in the state vector. So we can really just match coefficients rather than worrying about these random processes. All we really need is that the coefficients determining demand and the coefficients determining supply are matched. That's lesson 1 in economics. Okay, this was my motivating example. This is the output of that model. This happens to be for investors that wait 32 periods. Now those could be minutes or seconds depending on your favorite market before they trade again. You get a dramatic price reduction on the supply shock, by the way, everyone here is rationally anticipating that there might be a supply shock. This sample path is a particularly severe supply shock relative to their anticipations. The price jumps way down. Because why? Well, because many investors are not present in the market. That means all of this supply has to be absorbed, the risk of it has to be absorbed by relatively few investors. In this case, 20% of the investors are available every day. And then, of course, there's also the fraction of the slow investors who are lucky enough to be there and notice that these shares are available at a very low price. Now, over time, they're going to pass that large risky position that they got at an exceptionally high return. They're going to pass it on to other investors as they arrive in the market, and the price will recover as suggested by the motivation and the empirical evidence. The little hump there, well, I don't know if your imagination is as fertile as mine, but there's also a little hump in the average behavior of the cumulative return on S&P 500 deletions. Now, that's not a test, but in any case, the theory suggests that the effect of these shares being held off the market for a certain amount of time will cause the price to, quote, overshoot. Nothing irrational about it. All the investors in this model are behaving rationally. It's just that the fact that there's a supply, when the price jumped way down, all the slow investors bought a huge amount. They took their, in light of the risk and the expected return, they took large positions, and those positions are going to be off the market for a while. You might say, well, why not? What about the other slow investors? Why wouldn't they enter and take this opportunity and drive out this spike? Well, what's the cost of entry? This is something that was already addressed in Grossman and Miller. If you assume any leisure cost to entering the market, that is to monitoring your position on a daily basis and deciding whether to enter now or not, then there's going to be some investors that are not there. In this particular model, you can actually solve in the steady state the entry problem, that is the equilibrium fractions of each type of the population. But in the time varying case, it's quite a mess, and I haven't tried to do it. This is the same plot on a different scale where I showed two other cases, investors that are somewhat faster, and there's somewhat, that is the slow investors are somewhat faster, and there's somewhat fewer of them, more quick investors are present in the market. That means the supply shock is less and the recovery is not as severe, and the overshoot is not as severe. And of course, the completely efficient market, it's just a right angle. The price shoots straight down and goes straight across because nothing else is changing other than the shares that are held off the market by slow investors. Two more examples and we're essentially done. This is an example of Yigal Newman and Michael Ryerson a few years ago, in which they looked at the pricing of European telecom bonds when there's a large issuance. This particular plot is for the issuance of a Deutsche Telekom $10 billion issue. Now, the interesting thing about this plot is it's not the price, or in this case, yield spread of that particular bond. It's the entire European telecom bond market reacting to this giant supply of telecom bonds landing in the laps of a few investors that were willing to absorb that issuance. In this case, the issuance was announced well in advance, so as you might imagine, rather than the surprise situation I modeled a moment ago, in anticipation of this supply shock, the prices of the bonds were bid down in advance, meaning the yields went up, and after the supply shock occurred and the bonds were distributed over time to long-term buy and hold investors, the yield spreads went back to normal. Here's another example. This one is by Jan Peter Kulak, student in Lausanne, of secondary offerings of equities. Now, just to explain it briefly, the first vertical dotted line is the announcement date, and I'm paying no attention to the fundamental news associated with the announcement. I'm looking at the second vertical line, which I can actually point to, right there. This is, by the way, this bar is the offering price. All of these plus signs are the secondary market prices. This is on average over 300 and some secondary offerings. So as now the supply has been announced, the issuance has been announced on this vertical, on this date, over time the price goes up, it goes way down, and then it recovers. The scale in this period between announcement and offering varies based on the issue. So this is prorated. After the offering, it's in trading days. So it takes on the order of a couple of weeks for the price to recover. Giving you an idea, of even in a liquid equity market, how long it might take to absorb a big supply shock. This is the modeled version of an anticipated supply shock. Two cases, one with a lot of relatively slow investors and one with fewer and somewhat faster investors. So in one case, you get this run-up in price in advance of the issuance, a big drop in the price on the issuance date, and then a recovery, possibly with this secondary overshooting. And if you have really good eyesight, there's a ripple effect, which is a third-order effect afterwards. A limit order book market has the same features. If you imagine a bunch of buy orders sitting in an electronic limit order book market at prices 54, 53, and so on down to 47 cents a share, all of a sudden a large sale comes into this market. It cleans off all of the limit orders to buy down to a price of 49. Anyone that was sitting down there at 49, like as in Leonid Russu's theory, is absorbing this large amount of this supply shock. They will now try to sell it off by putting in new orders in the market. Somebody else will come along and hit those limit orders, and eventually the price will recover, maybe on the order of microseconds, depending on the kind of market, or maybe the supply shock was fundamental and the price will only partially recover. So that's the idea of what I had in mind, and I just want you to take away on this last slide the perspective. Asset prices can move away from what we traditionally call fundamentals if capital is not perfectly mobile. But to be more precise, the fundamentals that we capture in our asset pricing models should include in the state variables those determining the immediate and future availability of capital market by market. Models based on imperfect search are natural for over-the-counter markets and for dealer intermediated or brokered markets. Capturing trading delays is crucial, however, I would say, for almost any financial market. And the time signatures of the price responses to supply shocks help to identify the nature of the capital immobility. So I imagine there will be, I hope there will be some PhD students that will think now about collecting the times at which if different types of traders trade, and these price signatures that I've been speaking about, and try to help us get to a better understanding of how slow-moving capital affects asset price dynamics. Thank you very, very much for listening.